Another big week in real estate and lots to go over, including, of course, we just got a rate hike from our friends down south at the Fed there. Up north here, there was a big cabinet shuffle to discuss, and we do have a new Minister of Housing to talk about on this episode. We're also going to share a bit of a national housing update and then talk about, again, the affordability and a bit of the looming and increasing credit issues we're seeing across Canada. And real quick, just want to actually reach out and just say thank you to everybody who has been tuning in to our episodes week after week. We have been doing this for over 3 years now, over 170 episodes. And if you're new to this, well, Ryan and I are real estate agents here in Vancouver, and we basically release episodes every single week to help people stay on top of this fast-moving industry. You may have noticed we have no ads, and we will never have ads on here. We don't want to interrupt the flow of this information. The only ask that we have is that you share this episode with somebody that you know. So thank you in advance for that. Let's dive into today's episode. Right off the top, we are talking about the Fed rate hike that just happened. So the Fed just raised interest rates a quarter point on Wednesday this week. They are now at the highest overnight rate in 22 years, emulating exactly what we have here in Canada. We are also at a 22-year high. And in their press release, they also stated that another hike in 2023 is likely, quote unquote. And this was backed on, of course, the comment that if the economy continued to, of course, be stronger than anticipated, then the likelihood of another rate increase would also heighten. And well, what happened the day after the rate hike? Q2 GDP information was released, and it came in at 2.4%. Stronger than the economists had expected, which they thought it would come in around 1.8. So quite a bit stronger. So clearly, no signs of a recession here in the States. Economy running very strong down there. And let's keep in mind the GDP is actually picking up steam here because the Q1 report came in at 2% and then Q2 at 2.4%. When we look at what's happening out there, it's almost a bit baffling in the sense that the economy is beating expectations. The marketplace is beating expectations. Housing is beating expectations. Let's look at the stock market, for example. We've got the Dow, the S&P, the NASDAQ, all on an upward trend and hovering almost all three at all-time highs here. So they are strengthening in power as well. Kind of not what the Fed wants to see because they're trying to push the country into a bit of a recession to pull back the level of employment, pull back the amount of spending, and pull back the amount of growth so that they can get they can get inflation under control. We are seeing a similar sentiment in Canada here. And when we look at our inflation, we just tucked in under that 3% target at this month's announcement. But there are all sorts of headwinds out there that show that inflation could very well start to increase again in the upcoming months here. So while, we've kind of entered that band, the fight is not over yet. And I think this is why there's a bit of that hawkish tone from our Bank of Canada here when it comes to what people can expect moving forward as far as the interest rate further hikes or at a minimum, a hold. And I think one of the main headwinds to face here or to recognize is, of course, the interest payments on mortgages right now, because that interest payments are a part of the CPI basket. And those payments are up 30% year over year, understandably. So much of people's mortgage payments are shifted from principal into interest. And keep in mind, when looking at that CPI basket, interest on mortgage payments accounts for almost a full percent of that basket. And Ryan, I think you've got some other headwinds here that we should all be looking out for.
Yeah, I mean, we've kind of talked for some time that I guess specifically in Canada anyhow, that inflation getting down to about 4% was going to be relatively easy because of the baseline effects, meaning your year over year changes, when inflation was running at 8%, getting it to 7% and then 7% down to 6% and so on and so on. Isn't as difficult as getting the inflation from 4% down to 3% and 3% down to 2%. The amount of work required to get there is going to be a lot more and likely higher elevated levels of interest are going to persist before we see inflation at its target. And I know they've talked about this 2 to 3% target band, but I really feel like they're chasing 2%. They're not chasing anywhere above that. Furthermore, If you've taken a look at the future markets when it comes to oil, oil is going to be a big impact on our inflation. And while oil is down 21% year over year, the futures trends for oil is that it's currently sitting at about $68 a barrel. It's likely going to see $78 a barrel. And that will push and continue to push inflation, as so many things are connected to our energy sector, how we transport food, how we get around, so on and so forth. So expect to see that. And also potentially expect to see the economy in Alberta continue to become even more robust. As we look across the nation, we look at permanent residents. That is now still hitting a record all-time high in Canada, most of which end up renting. So I don't think you're going to see any kind of relief in the rental market for the foreseeable future. Rented accommodations, get this, accounted for 7% of the CPI basket, up 6% year over year, and likely continuing up. Rental rates in Toronto in Q2 alone surged 17%, which is bananas. So what does this all mean? Well, it's hard to wash out. It's hard to know what the Bank of Canada is going to do. It's possible they may decide to hold. It's also quite possible, seeing that our friends down in the States just raised, it's very possible Canada may do that too. However, I do feel that our economies are they're diverging a little bit. The US is reporting real growth, whereas Canada is reporting the opposite. I tend to think that even if we do get a rate hike, at the next announcement, it will be a smaller one, 0.25%. But then I do believe that they will hold for some period of time. So it's possible we'll see elevated rates, 5% for the next 12 months, 5-ish%, depending on what they decide to do. And that is, again, all based on the data that we have today without really too much changing.
And that is all going to come from our Bank of Canada, from Tiff Macklem, whose job is currently not at risk, unlike what we saw just happen in Trudeau's cabinet. There was a big shuffle this week. We saw 7 ministers lose their job, and 3/4 of the balance of Trudeau's cabinet was actually shuffled. They all have new jobs. And in a very magnificent and ironic twist of fate here, Mr. Sean Fraser, who was previously the Minister of Immigration, who was, who was overseeing the 1.2 million people coming into the country in the last 12 months, well, he woke up to a new job, and he is now the Minister of Housing. And as far as we could tell, and as far as we joked historically, it almost felt like the Minister of Immigration and the Minister of Housing never really spoke, because obviously plowing 1.2 million people into the country and dealing with the housing, there was never a solution from what they were planning to do on one side to the other. And so this person is now going to have what I think would be a bit of a rude awakening to being like, oh my goodness, all these people I helped bring into the country, because that was the mandate, now need houses. And I didn't really realize how difficult it is out there. For reference here too, prior to being elected into council or into government in 2015, this Mr. Sean Fraser worked as a commercial litigation lawyer. So I just had a question here, and please excuse my ignorance, and I'd love to see the comments to help me learn and be educated on this. But if you are a Minister of Immigration and you literally get a call the next day, say, okay, that's not your job anymore. You're now Minister of Housing. And there, from what I can tell, there's zero formal training in advance. It seems like a pretty radical move that happens within our governments to just completely change somebody's job into something that, again, I don't think they have training for. And please correct me if I am wrong here, but it seems like a very intensive change. I mean, put it this way, I'm in real estate. I've been in real estate for 6 years, at least as a licensed agent and investor prior to that. But if I got a phone call tomorrow that said, hey, Dan, you're not a realtor anymore, you're now a commercial litigation lawyer, I guarantee you I would be horrible at that job. I would fail tremendously. At least in the first year as I kind of ramped up. But anyway, please help me understand how we just shuffle people's jobs and do a 180 and expect them to produce and solve problems the next day, because I would love to know how this works, because it does not seem like a very tangible path to success from the outside here. But I don't really follow politics, as you could tell, Ryan. I don't know. Maybe you can shed some light on how this works.
No, process wise, it doesn't really add up in my mind either. I normally believe that the person most qualified to do the job is usually the person who should get the job. That seems to be a path to success, historically speaking. And I think, if memory serves me correct, our prime minister was actually, when he was elected 8 years ago, made the commitment of ensuring that people who were qualified for the jobs were getting the jobs. So again, I think, this is really more of an admission that things are not going well, that change needs to happen, that there was too much spending that's taken place. And now it's rearing its ugly head, and Canadians are having to pay for it. And Trudeau's got to answer some of these calls. You've got leadership polls when it comes to the Conservatives versus Liberals, where Conservatives are starting to create a bigger gap in terms of popularity. The Liberals are losing steam. The Liberals also made a deal with the NDP. And if you ever voted Liberal, I'm pretty sure you didn't vote NDP for that as well. So there's a lot of broken things. And again, I'm not super convinced that things like just simply raising interest rates is going to solve our problems. They're not. We need more comprehensive plans. People who understand housing, maybe who understand immigration, should be people who have spent a lot of time doing that should probably be the ones whose butts are in the seats. Anyhow, with that said, let's get back into some of the more data and look at some housing starts, because this is really what we need. Housing starts actually jumped in May, driven mostly entirely by the condo segment. That doesn't surprise me there, which increased 77% in 1 month. It's the most affordable way to get people into homes. So condos, that doesn't surprise me. Also, condo projects likely been in the pipeline for the last 3 to 5 years. They're coming to fruition. So we're starting to see some of those projects. On the other hand, when it comes to single family homes, this shows you the trend in the direction with which our housing is going. So to give you some perspective, back in 2012, when you had a building application for a single family detached home, there was roughly around 7,000 per month that were being issued. Then in 2020, that fell to about 5,000. And seeing where we are today, 3,900. So the trend is less and less single family homes, more and more multifamily, and more condo and that kind of thing. So if you own a single family home, or you were thinking about buying a single family home, they are becoming more and more like a unicorn, and probably more and more valuable as time persists. With that being said, numbers are down 45% in 11 years for single family homes. So big jump. Expect to see less and less of this. It's just, more and more, we're making more and more room for more and more people. As Dan just said, the immigration minister is now the housing minister. So at least he knows who's been invited to the party. And dwellings under construction have now hit a new high of 346,000, and that's up 10% year over year. I'm not sure this is still enough to help with supply, because in many ways I feel the supply of housing is not just a number of houses behind where it needs to be, but a number of years of building houses behind where it needs to be. Dan, what are your thoughts?
Yeah, keep in mind, these are housing starts. And if they're largely in the condo segment, keep in mind that supply won't become available to the public for 4 to 6 years, because that's how long it takes for these to be built. So we know we're in an inventory crisis today. Great seeing this trend going consistently upwards, and that more and more starts are coming to market. But will it hit that pace of basically population growth? Because we always hear these incredible numbers of how many more million homes need to be available today just to basically get us into a balanced market. So it's trending the right way, but maybe Mr. Housing Minister now will go to the new immigration minister and be like, oh, slow down, buddy, because I didn't recognize what was being created here. But time will tell, and we'll definitely be keeping an eye on that. So when we talk about housing further. We're going to do a bit of a national update for you where we saw sales jump up again. We're up about 25% in sales based on the lows that we saw at the very beginning of this year. So 25% increase in sales is fairly significant. And of course, let's keep in mind this is coming off of the last half of 2022, which was definitely a downward trend as people were shocked and stunned by those rate increases and basically pushed themselves to the sideline. The increase in these sales is probably at a bit of a cyclical peak right now as we're now obviously into summer months. We've got a couple rate hikes that have come since this announcement, and it will kind of suppress the overall sentiment and therefore sales overall. We are seeing listings inching up. Actually, a bit more than inching. They're up 20% in the last 3 months. That's listings, again, nationally here. Though, let's look at the bigger picture here. And these are still overall about 10% below our 10-year long-term averages. Active listings, which is what we're really looking for, inched up as well, almost a full basis point, almost a full percent rather, driven largely by Ontario. Ontario seeing it listings tick up quite a bit now. Again, bigger picture. So where are we sitting? Nationally, we're still only at about 130,000 listings. For reference, we go back to 2015, we go back 8 years ago, 250,000 active listings, almost double. And yes, there are a few million more people in our country since that 2015 data metric there. Price-wise, still going up. So nationally, home prices went up 2% in June and are up 6% in just the last 3 months. I mean, at the beginning of this year, if you were to tell me that home prices were going to go up 2% a month nationally, I would have thought you were crazy. And again, we are just seeing resilience nationally, and we're seeing it even more so locally here. So yes, that is the HPI that we are referencing when it comes to that increase in price, and that is a bit of a lagger. I think we're going to see a flattening at a minimum over the next quarter or so here, but no radical turn to the downside with pricing. So a bit of a flat line through summer, and then, fall will be a whole new world. So we'll see what happens when that comes.
Fall could also bring some different news for us too, though. There are signs of a recession all throughout Canada right now. Again, we were dealing with a lot of lagging indicators coming up to where we are now. If you speak to the businesses that are operating, if like you take into account the stories, for example, 2 weeks ago, we talked about being in a Soyuz where half the motels that are typically sold out months in advance all had vacancy. We're talking about a real change in the economy. And that's actually starting to show. So real GDP per capita went negative year over year in April. And while unemployment has risen 40 bips in the last 3 months, that actually equates to the fastest rise since the global financial crisis. So we're starting to see some of those other metrics in the economy tick up towards the recessionary, qualifications that we look for. Once we have the May and June data, it may say that we're actually officially in a recession. So that data is coming and will be very important for us to assess. We won't know that, however, until September, right? So it'll take us into the fall before we really can recognize this. A few other points here. The index of business confidence has dropped to levels consistent with prior recessions. And this is largely driven by interest rates for businesses, which are up an astounding 31% year over year in May. This is the highest level since 2001. And just to kind of reflect on that, we know some developers who are building some major products, and they've explained to us that while before interest rates rose, but to put a tower up, for example, they were looking at somewhere $10 to $12 million of interest costs. That same build is now looking at roughly $40 million of interest costs. So you can see why developers will hold back. You can see why businesses are choosing not to operate in the same fashions they were. It is so much more expensive to do the very same work that was happening just 2 years ago.
So let's talk further about credit and credit trends here, because credit really drives not only the housing market, but a lot of our economy and obviously the businesses, people who are taking out loans to run their businesses. When it comes to people who are applying for mortgages, well, essentially that number has slowed to the lowest since 2011. It's down at a 12-year low here, and it's understandable, right? Most people now that are actually making a move are typically moving up, down, or sideways. We've got a lot of investors who are pulled out right now. They're not really looking to buy too much product. And we also have first timers who are getting further squeezed and further pushed out of the marketplace, if you will. So a lot of people that are wanting to move, that are first timers or looking to be investors, they're just like, the numbers don't pencil right now, so let's just not get that mortgage. Mortgage trends, mortgage originations are way down. This trend has been going downwards basically for a year now. Kind of peaked around Q1 of 2022 and has been dropping ever since. And of course, the people who are making these moves, lateral, up, down, or whatnot, are predominantly focused on short-term fixed. So a lot of people are getting 1, 2, and 3-year fixed rate mortgages because the rates there are a bit more approachable. But of course, it's with the idea that they are firmly of the belief that interest rates will come down by the time they have to renew in 1, 2, or 3 years, because they feel this hiking cycle that we're in right now will have a peak and then start to peel off at some point. The rate of those 1, 2, and 3-year mortgages is upwards of about 80% of new mortgages. So it's obviously the vast majority here. Let's look also at credit cards, because credit card debt is definitely surging, and it's been in an upward trend since bottoming in January of 2021. It's up 7% in the last 6 months alone. So for reference, if we look at how much the outstanding credit card debt nationally was, it was about 86 billion pre-COVID. Today, that has ballooned up to $97 billion, an $11 billion increase in just about 2 years here. 2.5. So people are trying to maintain their lifestyles. They are making their payments. They're paying for groceries, etc., but they're doing it with their credit cards. Are they falling back on their mortgage payments? Well, the answer is no. We are still, when we look at housing and we look at mortgages that are in arrears, basically still sitting at an all-time low. We're just 0.15% nationally. So that means if you look at all the mortgages across Canada, which is about 5.1 million of them, there's only 7,600 mortgages that are 90 days or more past due. That is an incredibly low percentage, again, 0.15. People are still choosing to pay their mortgage first, no matter what. They're going to pull back on other things. They're going to get more into credit card debt. Whatever they do, they're paying their mortgage first. So no signs of distressed selling in the marketplace as of today. And let's think, like, even if those 7,600 odd homes that are in arrears right now turned into foreclosures and hit the market tomorrow, it would only push, and I'm talking that's nationally. If we took all of those homes and just released them in GVRD, it would still only push us into a balanced market. So the signs of a balanced and definitely a buyer's market are still way off in the horizon here. Interestingly, there is still a fair amount of excessive savings in people's bank accounts. And again, this is thanks to all the helicopter money from the early pandemic days, though that is also trending towards our long-term trends here. We're seeing retailer confidence falling, and it's basically back to where we see it at prior recessionary levels. So the retail market is falling off. And again, when we're trying to relate to when a recession may or may not come, you need a number of indicators, and this is one. The insolvencies in that marketplace are rising sharply, and they're upwards of a 10-year high, if you will. Looking back to homeowners and basically the overall, I guess, net worth that homeowners have right now, it is starting to fall as well. It peaked during the pandemic when all the free money happened and nobody had that much to really spend on because they were trapped in their homes. So household net worth down year on year, basically by the largest amount since the GFC. And this is, of course, because we saw home prices dip about 15% off at the peak. Yes, they've risen, but this is likely a lagging indicator. So homeowner equity levels falling at the fastest rate on record as well. So that's a big one to pay attention to, because that negative wealth shock will result in a big pullback in consumer spending. It's the wealth effect in reverse. If you feel like your house prices are going down, your interest payments are going up, your credit card debt's going up, you don't feel wealthy. And so you're going to pull back again on all your discretionary spending, which may very well push the country back towards a recession or recession-like environment here. After that equity rose the fastest that we ever saw, again during the pandemic, the opposite is now happening, right? Remember when everybody felt super rich and was buying like NFTs for $1 million? Well, you're not seeing that today because, of course, the exact opposite is happening. And, we're seeing a bit of that too in the affordability factor.
I wonder, because when we think about the current state of affairs, and you look at the fact that a place like the GVRD does not, only 50% of households in the GVRD have a mortgage. And I wonder, of those 50%, how many originated in the last 3 to 5 years. So it's, I feel like while the pressure to restrain the flow of credit will help bring down prices, you really need supply on the other side to create a significant price drop. And I just don't see that taking place. And the reason I say that too, Dan, is because when you consider the amount of immigration that's taking place, and maybe you consider the money that is also coming in with the immigrants as they bring that with them. Now, not everyone's, that's not going to be the case for everyone. But for those who are serious about buying real estate when they're here, it's almost like there's going to be an exchange of real estate between those who have money and those who don't. And it's those who are maybe looking to relieve themselves of that pressure. Maybe you got a mortgage in the last 3 years and now you're thinking, hey, you know what, maybe I don't need a house as big as this. I feel that while the population that's currently here may say, yeah, I'm not buying that either, population moving here may be jumping on that opportunity. Because again, bringing perspective as to what's happening here in Canada versus what's happening around the world, still a very desirable place to live, right? So I haven't seen enough movement in things like recession numbers, supply numbers, other metrics to really consider a significant downward pricing effect to take place. I do think we'll see lower levels of transaction volumes and things like that taking place with elevated rates, but I just don't think it's going to go away entirely. And I think we're probably likely to see those higher rates for a longer period of time as a result. I just don't know if they'll continue to go higher, because doing so would break a lot of things. I don't know. What are your thoughts?
When we look at affordability, for example, we do know that today, for these people that are looking to buy that, or even renew, of course, that the mortgage rates are at levels that we haven't seen dating back to 2007. We often talk about what pricing was like back then. If you take a variable rate today, you're above 6%. And if you're getting a fixed rate today, you're over 5.2%. These are much larger numbers that Canadians are used to from the last 15 odd years. The average monthly payment to purchase your typical home in Canada has jumped even further in the last few months. It's up 12% over the last 4 months, which equals $400 a month. Or, of course, that would be $4,800, almost $5,000 a month increase on top of where it already was from just 4 months ago. So your average payment for a mortgage in across Canada, if you're buying a typical home, is now $3,500 a month. And let's keep in mind, it was basically flat from the 10 years previous up to about 2021-ish, where it was only $1,600 on average. So we are more than double. It's a huge shock to the system. What are we, 2 years down the road since this has really started to increase? And yet, again, we're seeing resilience somehow, but that I think can only happen for so long. So this is why we're seeing things like credit card balances starting to really increase, because people are getting more and more stretched. So affordability, tougher and tougher, right? We've never seen a higher mortgage payment than is required to date to buy a typical Canadian home. So it's going to continue to separate, I think, the economic divide will only increase between the haves and the have-nots here.
Yeah, we're slowly seeing the destruction and erosion of that. Well, maybe not slowly. We're seeing the destruction and erosion of the middle class in, at least here locally. It's definitely apparent.
There you go. Okay, so great place to wrap this one up. Again, thanks as always for tuning in. Please educate me on how our political system works and how these people are educated on their new jobs that they all woke up to yesterday. And if you found some value here, we would love it. We would appreciate it so much if you shared this episode with just one person. Thanks as always, and have a great day.